Now, when you buy a stock, we do need to understand how this works. You are actually buying a piece of ownership in the company. You're buying a piece of ownership in the company. Let's do this way for just a second. I'm going to open a company, and I'll tell you what, let's you and I open a company. What's your first name, sir? Dwayne. It's good to meet you. Thank you, sir. Dwayne and I, as an example, are going to open a printing company. We're going to go in the printing business together. Okay, Dwayne knows a lot about printing. I don't know anything about it in our example. Are you in the printing business? Good. Okay, this is an example, all right? And so he's going to come to me. I'm going to put up a little money, and he's going to go in and do the work and get the accounts and learn about the paper and the ink and that kind of stuff. And so we decide we're going to form a corporation, and we're going to own it half and half, and we're going to issue 100 shares of stock, a share of stock. And he's going to have 50 shares of stock, and I'm going to have 50 shares of stock. So we're 50-50 owners in this company. A share of stock represents a piece of ownership in that company. Dwayne and Dave's, the D&D print shop, right? Okay? And so then what happens to this company, what happens to its value and its profitability as a stockholder and owner of the company, I get to participate in winning or losing with that. If I sold a share of this stock to someone else, then as we made money or lost money, then that person would benefit. Now, how does that happen? Well, if you're an owner, think about it. If you owned your own print business, forget stock a second. If you owned a company, if the company did better, you'd be doing better, right? In a couple of different ways. Your return comes as the company increases in value. Now, let's say we go along and we have one little print shop and we're winning, and Dwayne's really good at this, and he goes out and gets a bunch of accounts, and I maybe do the accounting or the financial stuff over here, and he's an excellent printer, and we build up business so much so we can't fit it in that, and we open up another building, and pretty soon you visit us 5-10 years later, and we've got print shops in 6 different cities. Now, is this one share of stock, my 50 shares of stock, worth more with print shops in 6 or 8 cities that are profitable? And I've got all that equipment? Yeah. And so that's what happens. That's how a share of stock goes up in value. If you buy a share of a company like a Home Depot or something, and it goes from $52 a share to $72 a share, it's because the company became worth more, just like our print shop. And you're a little bitty dinky sliver of an owner when you own a share of stock in a publicly traded company. Same kind of thing. Or you, the owner, can make some of the profits out. And we have D&D print shop, and maybe we make some money. Hey, there's an idea. And Dwayne and Dave's print shop. And maybe we made $40,000 that year. Well, if we're going to take that money out, that would be called dividends. And so if you own a share of a publicly traded company and they make a profit, they may choose to issue dividends. And so you may get a check that's your little sliver of the profits for that year of that company. That's what stock ownership is. So you make money as the value of the company goes up, or as it makes profits and pays out dividends. Some companies are big dividend paying companies. My grandfather, for instance, when he was alive, worked many, many years, 38 years at Alcoa Aluminum. And when my grandmother was alive, after my grandfather passed away, she knew which Tuesday of the month or which day of the month the dividend check was coming. He had some Alcoa stock, and they were making a profit, and she could go to the mailbox and there'd be a check. She didn't even really know what it was. She just knew dividends meant money. She didn't understand exactly how it all worked, but she cashed those checks, I'll tell you that. And so she was making a little, as Alcoa Aluminum made money in those days, he participated in the profits by getting dividends checks. Now, bonds are a debt instrument by which the company owes you money. Now again, let's go back to Dwayne and Dave's print shop. Now you know that if Dwayne and Dave, the D&D print shop, if I'm involved, we're not borrowing money, but we got to do this as an example, okay? Let's say that we wanted to borrow $10,000. If we were a publicly traded company, we could issue a bond. And what's your first name, sir?
Stan.
Stan? It's good to meet you, sir. Let's say Stan, he really kind of liked what we were doing over there at the print company. It looked pretty good to him. He knew we weren't really going to cut him in as an owner, but he trusted us to be able to pay the bill. And so we issue a bond for $10,000 to Stan, and he gives me $10,000. Come on, Stan. Come on, baby. Okay? And he gives us $10,000. Now, we owe him a debt. of $10,000. Does that make sense? That's what a bond is. It's a debt instrument. If it's a government bond, the government owes you a debt if you own a government bond. That's what it is. A bond is a debt instrument. Now, the way you make money on bonds is there's an interest rate involved. Stan wouldn't have given us that money if we weren't going to pay him interest, right? So we're going to pay him interest on it. Now, let's say, just for simplification, that we were paying 10% on our bonds. And if we pay 10%, then Stan's going to make 10% on this. And at some point, this has a due date. We have to give him the whole $10,000 back. But in the meantime, every year, we're sending him 10% on this $10,000 bond. And that's all it is. So your return comes on a bond. And again, you get a little certificate thing like that. Your return comes as a fluctuation in price and the interest rate is paid. So bonds go up and down in price. And few individuals do well with single bond purchases. Now, let me take this just a little bit further and walk over into the very edge of sophistication. I can't even say it, see? And so, let's say that we have a 10% bond, that I'm paying him 10% in the open market and the stock market, right? Stocks and bonds. You've heard about this. Okay, I'm paying him 10%. Let's say that the interest rates around the world are starting to average 12%. But his bond only entitles him to 10%. Is his bond worth a little less or a little more if everybody else is getting 12 and he's only getting 10? He's worth less. So as interest rates rise, bond prices fall. There's an inverse relationship. So if your grandmother has a whole bunch of government bonds that she's purchased thinking they're safe and interest rates are going up, she's starting to lose value in those. And can do so pretty quickly if interest rates shift quickly. And so I don't like bonds, not because of that. They're just as risky as stocks. They jump around all over the place. They're a little safer than stocks, but the bond market throughout its lifetime has only averaged about 8%. So I don't own a single bond. I don't want to make 8% on that. I might end up making a mess like I'm doing right now. That could happen. So again, few individuals do well with single bond purchases.
A fund between two people where
more than one fund.
A fund between two people, consensual.
It builds itself up over time.
I would assume that it's just where you come to an agreement with another person.
Mutual funds. Mutual funds are where investors pool their money to invest. Portfolio managers manage the pool or the fund, and your return comes as the value of the fund is increased. What in the world did he just say? Let's try this. This is a mutual fund. I'm going to be the mutual fund manager. We're going to open a mutual fund. And you guys are going to invest in it. What's your first name, sir? Randy. Randy's going to put some money in. Your name, ma'am? Michelle. Michelle is going to put some money in. Your name, ma'am? Diana's going to put some money in.
David.
David's going to put some money in. Dan is going to put some money in. Alicia's going to put some money in. Michelle's going to put some money in. Ryan is going to put a lot of money in. All right? So what has just happened here? This group of people has just mutually funded this. It is a mutual fund. This is hard, isn't it? That's all a mutual fund is. A group of people bought into something together. Usually something they couldn't do by themselves. Because I don't have $1 billion, but I could buy into a mutual fund that had $1 billion and get some of the advantages of playing with people that have $1 billion. And we'll talk about those. Now, what I do with this money as the manager of this mutual fund tells us what kind of mutual fund they bought. If I took this money and I were to buy something like maybe these bonds we talked about, maybe I bought bonds, then this would be a bond mutual fund, and we usually call it a bond fund. Have you ever heard of a bond fund? That's all it is. Instead of you taking $10,000 and buying one bond, if you put $10,000 in this, there'd be a gazillion different bonds in here, and you'd be spread out across a bunch of different bonds. You'd be diversified. You wouldn't have all your eggs where they could get hit with something. You're spread out across more bonds instead of owning just one. by being in a bond fund with some other people. Now, if I bought stocks in companies that make things like Dove soap, like Country Crock butter, like Vaseline, like Q-tips, like Slim Fast, like Lipton tea, like Ben & Jerry's ice cream, all detergent, Brute aftershave, Dannon yogurt, Nescafe, Butterfinger, Alpo, Panasonic, or JVC, these are all companies that are not American companies. They're foreign companies. They're overseas companies. Now, a lot of those products are made stateside in factories right here in the U.S. Some of you may work for one of those companies right here in the U.S., but the company is, and certainly their products are consumed here. Those are household names I just named in America. But whether the product is consumed or made here is not what I'm talking about. The company is not an American company. They're an overseas company, which is not a bad thing. But if you were to buy stock, if I were to take the money out of this mutual fund that these people mutually funded, and I bought stock in companies that make things like that, I'd be buying stock in overseas companies. I'd be buying stock in companies internationally. I'd be buying stock in companies in foreign countries. And see, the name of the mutual fund starts to tell you what's in it. If it's a bond fund, what's in there? And so if I'm buying stock from companies that are overseas or companies that are international, this would probably be called an international stock mutual fund. You starting to get it? This is how it works. If I take the money out of here and I were to take it out and I were to buy something, I were to buy companies maybe like General Electric, maybe like IBM, maybe like AT&T, maybe like Home Depot, maybe like Cracker Barrel, or maybe, I don't know, let's see, here's another one, Federal Express, or maybe Walmart, or maybe Microsoft. I could buy either one, right? Or maybe Kmart, or maybe not. And so I could buy stock in companies that some of them, 90 to 200 different companies, America's best and brightest companies, and maybe these stocks, remember it's a share of ownership when I buy stock in it. And instead of buying one company, these guys have bought into this together. They mutually funded it, and they bought a whole bunch of different companies, so they got that diversification. Their eggs are spread out. They're not in one basket. And if I buy stocks and I buy into a mutual fund where there are companies that are growing, we might call their stocks growth stocks, which would make this then a growth stock mutual fund. Oh, you're getting it. That's what a growth stock mutual fund is. It's a group of funds, a group of stocks in a mutually funded account. People mutually funded it in companies that are growing. And it goes up, and sometimes it goes down, depending on what the economy is doing and this group of companies do. But if I bet the whole thing on one company, I could lose it all, couldn't I? My eggs could crack up. So if I put $1,000 in one basket for my kid's college, it could crack up. Or if I put $1,000 in here, it's spread across a bunch of different baskets. So it creates diversification. So I like this, because remember, diversification lowers risk, because diversification means to spread around. In other words, what we're saying with money is this: money is a lot like manure. Left in one big pile, it stinks. Spread around, it grows things. That'll come to you later.
Hey guys, one of the most common questions I get from folks your age is, where and how do I open a mutual fund, and how much money do I need to start one? Well, let's start with the second part first. How much money do you need? A lot of mutual funds will open an account for as little as $250 or $500. And if you want to put money in every single month, you can open a mutual fund for $25 a month or $50 a month with some of them. So just check with your broker to do that. Now, where and how do you open a fund? A little more complicated. I'd recommend you get with a good mutual fund broker, one that has the heart of a teacher, one that will sit down and explain to you what you're doing till you understand it. Remember that rule of investing: don't put money in anything you don't understand.
How does someone know if a mutual fund is successful?
There's a lot of research out there, Rachel. There's probably 25,000 different mutual funds. So my suggestion would be that you keep it really simple. First, only invest in mutual funds that have long-term track records. These companies have been around for 10, 20, 30, 40 years. they have a much higher probability of doing well over the next 10 or 20 or 30 than a mutual fund that's been around for a week. So find mutual funds that have been around for a long, long time, and then secondly, invest in mutual funds that are a little bit broad in their description as opposed to only being able to invest in one particular item.
How long should someone keep their mutual fund?
Probably one of the biggest mistakes people make is that they buy a mutual fund that doesn't have a great long-term track record, and then they sell it within a year or 2 or 3. And the key is to find a fund and buy a fund that's been around for 20, 30, 40 years, and then keep it for a long time. People make money over the long term, and the problem is if you're always making changes, you're chasing your tail and you're going to sell low and buy high. So as long as the fund's been around for a long, long time, then I would buy it, and I wouldn't plan on selling it until you retire.
Jeff, what would you advise someone to do if the mutual fund they had was losing value?
Well, I think what you could do is talk with your advisor and say, hey, is this losing value because everything else is losing value, or is this losing value because it's horrible? Over the years, there's been times where the market's been down 50%, and you don't want to stress, you don't want to bail, you don't want to get out. That's not a problem because everybody else is down as well. So as long as everybody else is down, you know you're kind of in the crowd, then stick with it. But when everybody else is making money and you're losing it, then you need to get out.